It became the longest strike in the history of South Africa and one that shook the mining sector to its core. The Association of Mine and Construction Workers led its 100,000 members in the platinum sector on a 5-month-long strike in January to press their demand of 12,500 rands a month. A period of intense negotiations followed, which saw the affected platinum miners, Amplats, Implats and Lonmin, as well as the workers lose billions of rands in revenue and income and forced communities to their knees. AMCU finally accepted the wage offer that would increase the basic salary of the lowest paid workers by 1,000 rand over 3 years, excluding other benefits. The cost of the strike: the mining houses forfeited around 24 billion rand in revenue and employees lost earnings of some 10.6 billion rand. Another strike followed in July. This time it was NUMSA, which declared a wage dispute with employers in the metals and engineering sector. The parties settled a month later after the 220,000 NUMSA members agreed to a 3-year wage deal, giving its lowest paid members an increase of up to 10%. However, the strike is not quite settled. Employer body NIASA has refused to accept the agreement, saying its members cannot afford it. It's implemented a lockout, even though the Labour Court has ruled that the agreement must be extended to all employees in the sector. And still with labour matters, tension between COSATU and NUMSA came to a head in November when the latter was expelled from the Trade Union Federation. NUMSA and COSATU had been at loggerheads since the latter's General Secretary Zwelinzima Mavavi was suspended over an office affair, and NUMSA resolved to withdraw its support for the ANC before the general elections. The metal union's decision to recruit in other sectors added to the tension. The move to expel NUMSA could see COSATU weakening further. 7 other unions siding with NUMSA have indicated they will fight the expulsion. NUMSA may also form a political party to contest the 2016 local government vote. The post office strike wasn't as headline-grabbing. Nonetheless, it had far-reaching consequences on people from all walks of life. The crippling 3-month-long strike disrupted postal services and saw mail and parcels pile up at mail distribution centers around the country. The 3 unions active in their sector finally settled for a 6.5% increase across the board. However, Communications Workers Union has indicated it may down tools again in January if the outstanding issues are not settled to their satisfaction. The impact of these strikes, in addition to power shortages, rising unemployment, slowing global growth and declining commodity prices, had a severe impact on South Africa's economy. Treasury has revised economic growth downwards to 1.4%, the slowest pace since 2009. These factors, as well as the widening of the current account deficit and government's ballooning public servants' wage bill, contributed to a cut in South Africa's credit ratings. Standard & Poor's set an example in June. Moody's followed suit in early December. South Africa avoided further cuts a week later when S&P and Fitch retained their outlook on the country. Credit ratings are important as they help determine a country's cost of borrowing and influence investor appetite for its debt and equities. This affects how much capital flows in the country and the value of its currency. South Africa's big 5 banks were also in the rating agency's firing line. Moody's downgraded Standard Bank, Absa, FirstRand, Nedbank and Investec following the collapse of African bank investments in August. Able flagged a headline loss of 6.4 billion rand, causing shares to tank. The Reserve Bank stepped in with a 10 million rand recapitalization plan and placing unsecured lender African Bank under the curatorship of Tom Venterbur. Ellerins, the furniture retail from arm of Able, would either be sold off or closed down. In other company news, Woolworths showed up its muscle on the world stage with a 23.3 billion rand takeover of Australian clothing chain David Jones takeover bid.